kids. They went berserk.
Oh, and there she goes. We just lost her. So I am going to end. I just lost my presentation. What is going on? Fishing. Oh, no. Getting sick's terrible. Especially when it starts warming up outside. Dude, what happened to my presentation? Just disappeared on me. All right, 2 seconds. I'm still trying to, for some reason, this thing keeps dropping out on me. And we're getting more and more people coming in. So we're just going to give it a few minutes, let some more people filter in, and hopefully this thing stops poo-pooing on me. Hi, Lisa. All right. You got to love technical difficulties first thing in the morning. All right. Let's just hope that this stays up and we don't need to open it again. All right, you guys. So I'm going to share my screen with y'all. If I can find the share screen button, there's more things opening up. Stop opening. Oh my God. All right, y'all. Let me know. Can you guys see that? With the screen?
Yeah.
Yeah. All right. Perfect. So let's start by going over a couple of pretty important topics. One of them being, did you know that there's a loan limit here in San Diego across the country? So there's several different types of loans out there, right? You've got conventional loans, FHA loans, VA loans, jumbo loans, and then and those are pretty much the conforming loans. Am I going really slow or is it me? I feel like everything is like in slow motion right now. No? All right. Cool.
Everything's good. Yeah.
All right. So,
what did you do this weekend?
Seriously, I don't know what's going on. So the conforming loan limits, right? In San Diego and across the country, it's 726,200, right? That is what the loan limit is. Now, there are some more expensive areas like San Diego, right? Where it does, we are able to use conventional guidelines, which are a little bit less stringent, shall we say, than jumbo guidelines, right? And we can use them all the way up to $977,500 here in San Diego. So at that price point, you only need to put down 5%. Up to 726, you only need to put down 3%, you guys. So it's like one of the biggest myths that people like get so confused about and like, and totally don't realize that, hey, I need to put 20% down. Not necessarily true. You could totally get away with just putting down 5%, 3% and still purchase a home. So this is the highest high balance loan limit is 1,089,000 solely. You can find that up in like Los Angeles, for instance, right? And then some other places, I think Hawaii goes up that high. There's some little pockets across the country that will go that high.
Orange County and Northern California, both.
Yeah, thank you, sir. So yeah, it really depends on where in this region, but keep in mind, you cross that border and you're heading up to Riverside, for instance, and you want to show places up in Murrieta, you can't go over that 726,200 because they don't have a high balance, right? So just be very, very careful when you guys are making that transition to showing places up there. What's up, Sheldon? I don't want you to get caught and saying, oh, hey, by the way, we started and let us know after the fact and we've approved somebody for like $800,000 or $900,000 here in San Diego. And then you guys start heading up there to show them places and not tell us, and then it'll backfire on us. It's happened before, so that's why I bring it up and make sure that doesn't happen. So again, different types of properties, different types of, so a 1 to 2 unit, right? 3 unit, 4 unit, they're all going to have different loan limits. So you can literally, I mean, over $1.5 million is almost 1.7 that you can go and get a fourplex and still be conventional conforming loan limits here in San Diego, which is pretty huge, you guys. It's a really big benefit. And just understand that once you get into the jumbo territory, you're talking about a lot more restrictive guidelines. They start digging into your income a lot more. If you have any kind of variable income whatsoever, it is going to be a lot more stringent as far as how they calculate it. Their debt to income levels are going to be lower. Their reserves are going to be higher. So they pretty much put you under a microscope a lot more than if you were just using a conventional conforming loan. So that's why we try to stay in that realm as much as possible. The majority of the people that we do deal with usually do wind up purchasing in that price point range. And so, yeah, just keep in mind, there's some very basic loan level limits that we have to abide by, right? So moving along, you guys, you're going to pick up a listing eventually, right? And you're going to wind up having to make sure you do the walkthroughs. And you're with your buyers as well. You're walking through a property. Make sure you're keeping an eye out on smoke detectors. They have to be in front of every single room. And they have to have carbon monoxide detectors in the property, as well as having double straps on your water heaters. So unfortunately, these are overlooked sometimes, and we wind up getting into escrow in the last minute. Like you have an agent scrambling around trying to get to Home Depot, right, to pick up a smoke detector. So just try to avoid that when you're running through the property, and you're walking through the property, when you're doing your AVID. I believe that's a proper terminology for your final inspection there, right? Just keep an eye out on those things so we don't have to rush around last second. So there are also other guidelines, right, when it comes to conventional loans, FHA loans, VA loans, right? So there's loan limits on these loans, but there's also, bare minimum credit limits that you have to abide by. So with a conventional loan, 620, you wind up getting into an FHA and VA, it's going to be a little bit lower. You can go all the way down to 580 with us. And there do have to be compensating factors when you start getting that low. So you have to have, for instance, a long time on the job. You have to have good reserves, a consistent employment. You can't have fluctuating income. Those types of things are compensating factors that the underwriter will look for when doing these underwriting. And it will wind up going through and probably doing a manual underwrite. So instead of an automated one, when you have a lower score, sometimes you can't get that approval and you have to manually review it. And so we're able to do that, but we do need to have we have to meet the minimums at the very least. So again, the FICO score is 620 for conventional loan. Remember the down payments, just mentioned them, 3%, up to that 726 mark. 726 mark, and 5% if you go over 726,200 all the way up to 977,500. Why some of these are updated and some of them not, I don't know, but they're all going to be updated after this meeting. So again, depending on the amount of units, you guys, you can't just step into a 4-unit property and put 3% down if you're a first-time home buyer. There are different requirements. So if you start doing a duplex, 15% is going to be your minimum down payment. You probably never want to buy a multifamily without putting at least 20 to 25% down. But a 3 to 4 family, for sure, you can't put less than 25% down. So just keep that in mind if you have someone that's pre-approved, because so many people right now have been having these conversations like, oh yeah, we're going to buy a multifamily, we're going to move into one, thinking that they can put 3% down. Doesn't work that way. All right. So again, anything that you wind up picking up from our conversation today, make a quick reel about it. Like, hey, did you know that you can use an FHA loan to buy a multifamily with 3.5% down? that you didn't. I'm going to tell you a little caveat about that in a minute, right? But just keep in mind that you can't do that with a conventional loan. These are the minimum downs that you have to put. Second home you're buying, 10% down. And investment properties, 15% for one unit and 25 for a multi-unit. Again, investment properties, you probably don't want to be getting into investment properties and having mortgage insurance, right? By not putting a 20% down. So 15%, although it's a minimum, is not encouraged, or you probably won't ever break even on your monthly payments here in San Diego if you're just putting the bare minimum down. So along with requirements on your credit, remember what I mentioned, you have to hit the 620. You also can't have any kind of major credit events in recent history, right? So short sales and foreclosures, you're talking 4 year, deed in lieu of foreclosures are 4 years, foreclosures are 7, bankruptcies, 4 years. So it just depends on the type of bankruptcy as well. We can get away with using different types of loans, and we can outsource our loans if people do have credit events to a broker and broker these loans that have shorter waiting periods. So if someone does have a recent credit event, we'll see it on their report, but it's also something that, you may want to ask when you're speaking to clients. Have you saved some money for a down payment? What's your credit like? Have you had any major events recently? It's okay to ask these questions. And honestly, like some of the top agents that I work with, they'll kind of scrub, a conversation with a client up front just to make sure that they're dealing with a viable client, that they're working with someone. If someone tells you that they just filed bankruptcy 2 years ago, you know that you're probably not going to be able to transact. So you may want to utilize your time and refer them to a credit specialist to start rebuilding their credit. And we can help with that for sure. I think a lot of you guys, most of you guys have been on our call with B Squared Credit, who is now Blue Water Credit. And so, we'll definitely help people get into the position where they need to get to. It's part of our job is to kind of help them understand how did they get to the road that they need to be on to be able to buy a house, right? If they can't get to the starting line right now, we'll help them get there. So credit periods. I covered a couple of topics so far about conventional loans. Does anybody have any questions? Because I'm just going on and on. I can keep talking for days about this stuff. No? Cool. I'll keep going. So let's see. Mortgage insurance costs. Are you guys all familiar with what mortgage insurance is? Yes, no, maybe so. If you don't put 20% down, you are required to purchase mortgage insurance. And what does that mortgage insurance do, you guys? It protects the lender because you don't have enough skin in the game in their eyes, right? So they're worried that you're just going to walk away from this property if you lose your job, if you fall on some hard times, what have you, and you only put 3% down. Well, what's stopping you from walking away? So what they do is they require you to buy mortgage insurance, and the mortgage insurance is going to cover that loan if you do default, right? But who's responsible for paying it? You are. Guess what? So your mortgage insurance, again, just like interest rates are based off 20 different variables, same thing with mortgage insurance. When I'm trying to figure out mortgage insurance, I've got a whole form and I've got to plug in all these different variables, everything from purchase price to credit scores to type of property to the purpose of the property. Is it owner occupied, second home, what have you? So there's a lot of different variables that go into determining what the mortgage insurance is, and that's going to be added on to your monthly payment. All right. So the way that it works is if you don't have 20% in mortgage in down payment, you will be required to buy mortgage insurance. If you're required to keep it until you either naturally hit 25% of equity, and that can happen multiple different ways, right? So of course, every time you make monthly payment, you're paying down that loan, right? So there's going to be a point that if your property isn't appreciating, you would have just paid down the loan to 25%, right? But if your property is appreciating and you're paying it down, more than likely it's going to happen quicker, right? So you're required to keep it for the first 2 years. If you hit 25% between 2 years and 5 years, you can petition your servicer to remove your MI. And I've had a ton of clients hit me up that have bought houses over the past few years that put minimal amount of money down, and we were telling them, hey, hold off. Properties are appreciating. Don't put a ton down. You'll be able to get rid of that MI later on. Don't worry about it now. Hold on to that money. Invest it in other things. Maybe improve the home. You improve the home. Your home is worth more. Guess what? You hit that 25% quicker by investing that money instead of putting it down on the down payment and worrying about that, right? So again, 25% for 2 to 5 years. If you hit 22%, okay, after 5 years, you can petition to get it removed. And all that is just getting an appraisal done and including that appraisal, sending an email to your servicer. If it's done through Movement Mortgage, we service all of our own loans. So you can just hit me up and I'll give you just instructions on how to get it removed, or have your clients give them instructions, or our clients how to get it removed, and it goes away. And then all of a sudden your mortgage payments drop, right? So this is with a conventional loan only. It doesn't work with other types of loans. So I just want to make sure that you guys understand that it's just conventional loans with mortgage insurance, right? So any kind of questions on MI? It's kind of how it works in a nutshell. All right, feel free to chime in, you guys, if anybody has any questions about anything. Let's see, condominiums, right? Fun topic. So condos, there are some requirements for condos with conventional loans. The big ones being that you can't have one entity owning more than 20% of the property. So for instance, if you have like a 5-unit and you have one person own 2, well, guess what? They own more than 20%. The thing is that if that person is selling one of them, that's great. You might be able to do a loan in there. Otherwise, we can petition Fannie Mae for an exception to do an owner occupied in that subject property, right? But it may or may not go through. When you have, there's like this one complex up in Del Mar that's insane. It's like 70-80% is still owned by the developer from like the 70s, right? He just kept most of it. And so somehow, some way, we were able to do a loan in there. Someone made a mistake in the condo department, in their HOA department, their management department. Thank you. Brain fart first thing in the morning. And they filled out the paperwork wrong, and they didn't say that one person owned it. So we go off a questionnaire. A bank is going to send that management company a questionnaire where it's like 3 or 4 pages, and they have to fill it out, and they have to be honest. These guys lied on their questionnaire, whether they did it on purpose or not. It doesn't matter. We were able to get a loan through there, and then when it came to refinance, somebody filled that out correctly, and guess what? They didn't want to let us do it. But then we went back to them and said, hey, why wouldn't you want to lower his rate? Like, we already did the loan there. You guys screwed up and let it happen. Let us at least lower the rate and help the buyer back. And we got an exception. They let us do it. So again, Fannie Mae is not unreasonable. And we're a direct lender for them. And we work hand in hand with them all the time, especially on huge technology projects that go nationwide. So they're very happy to hear from us. And we've got an amazing condo department that will take things a step further. So something that Matt and I do, for instance, whenever we have any kind of offer that's going in, or we have a client that's really interested in a particular property and going to submit an offer, we have what's called a pre-submit department. And we can put all the information of that condo department into a spreadsheet. It gets submitted to our condo department, and they go out and they try to get that apartment complex approved in advance. So by the time that you guys wind up getting into escrow and making some offers on the property, hey, guess what? The complex is already done. We're good to go. We know exactly what we need. We know if we can do financing in that property. You know, a lot of times condo complexes, they take forever to get back to you. Like, it's one of the things that can drag on and on in a transaction that can really delay things. Things like condo approval, IRS transcripts, verifications of employment, all these things can really delay the loan. And so that's why we do all of our underwriting up front. That's why we go through all these steps and all of our due diligence to begin with before you guys ever start submitting offers, because that way it's a crystal clean file. Like, we don't have anything that's going to hold us up or wait. We could put in offers for 10 days and start competing with the cash offers out there. I mean, talking about differentiating yourself on a conventional loan, when you're submitting that offer, that's huge. We get to the point with some clients that we're so done with their loan, I don't even need a loan contingency. Like, you go ahead and put in your appraisal and inspection, it'd take the loan right off because I know I'm going to close this thing. So that's the benefit of doing all this underwriting up front, right? And with condos as well. Getting back to condos, sorry, squirrel. So again, I mentioned that, you can't have one owner owning more than 20%. You also have to have the HOA has to be in healthy condition. So they need to have reserves. They need to have money sitting on the sidelines to be able to pay their bills. There have been some HOAs that we pulled up that have 0 reserves and are going month to month. And so it's one of those things where a bank will not loan in that property without those reserves. And then another huge misconception that we hear a lot is, oh, hey, this property has more than 50% renters in there. Is that a big deal? Can we still do a loan in there? If you're doing an owner-occupied property, Fannie Mae, Freddie Mac do not care about owner occupancy rates, right? They just don't care. Why? Because you have another owner going into it, and you're gonna lower that investor concentration in that property, right? And they want that. They want more owners to live in the condominium complexes. They want less investors. Mateo.
Question in the chat, Aaron.
Yeah. What if it's a new development for a condo and all is owned? Yeah, that's totally normal. New developments are handled completely differently than existing established developments. That's a great question. And can you chat about spot approvals and what the process looks like? Absolutely. So again, new developments totally different from a conventional standpoint. They're all pretty much approved right from the get-go. All right. And you're able to do them in new projects, not a problem. They still need to get FHA approved and they still need to get VA approved. So if you do want to do one of those loans, you do have to have the management company has to submit a full package of documentation over to the FAA, the Federal Housing Authority, or the Veterans Association Administration, and they have to get that approved no matter what. If you want to be eligible for one of those loans. However, conventional, they're fine as long as it's completed. The majority is completed into where they're going to be moving into. So, a lot of condo complexes are built like in different stages. So as long as that particular stage is complete and they've moved on to another one, we need 90% completion in those stages and we're good to go. And then a spot approval is also a really good thing for us to be able to do for you guys. So say, for instance, you had a property that was FHA approved that's expired, because those guys expired every single complex in the country back in 2011 and made everybody apply again. And so many people didn't. A lot of them didn't. I don't know about most, but a lot of complexes did not get reapproved. And so we can request directly through FHA, for instance, if we can get a spot approval for that particular property right there. Hey, Rosemary. No worries. So again, it's one of those things where you need to let us know, ask us. Hey, Eddie, hey, Matt, can you please look into this complex for us? We want to make an offer on it. Is there any way you can submit over for a spot approval? And we will reach out. We will submit it through our pre-submit forms that we have to our condo department. They will reach out. They will buy all of the, they will purchase all of the condo documents that we need in advance. And then again, if the client ever does make an offer onto that property and they do wind up getting into escrow, they will have to pay for those condo documents. If they don't get their offer accepted, we're not going to charge them money for it. But it's something that we will do in advance and submit it over and request an approval for that one particular unit to get approved. So, which is a pretty cool option that we have, that most other banks are not going to go out of their way to do something like that, but we will. We'll definitely help out with spot approvals.
So Eddie, how long does that process actually take?
So it depends on how complete that package is. Usually it's pretty quick. It could take a couple of weeks, right? But if that management company is slow to get back to us and we're constantly reaching out to them, it's one of those things where our hands are tied, because if we can't get the documents that we need, we can't submit it over for a request. So it really, a lot of it depends on, but it usually just a couple of weeks to get a spot approval at the latest.
And a lot of these HOA and condo companies are managed through like the online. So you got to wait until they look at their online portal before they even submit anything. So it's all about the waiting game with a lot of these complexes and HOA companies.
I mean, if you guys are proactive and you want to call on the management company and start busting people's chops, and maybe even if you have a listing agent, if you're the listing agent and you want your seller to call the HOA or the management company, that was going to have a lot more power than you calling or I calling, right? Having somebody that actually owns in that property. But yeah, it doesn't take long at all.
So I'm kind of looking at this from both sides, from a seller and a buyer. So as a listing agent, you'd want to start this process while you're, getting the title report and getting everything prepped to actually go live. So that way you have more options for buyers to come in. Now, on the buying side, we're going to assume that all realtors are good realtors and do their due diligence, but sometimes that's not the case. Whereas a listing agent might not even look into the fact that it could be VA or FHA approved. Now, can you do spot approval for VA and FHA?
FHA, yes. VA, not so much.
Not so much. Okay. Because I mean, a lot of our first time buyers are looking into the FHA loan, and they're looking into kind of that lower price point. So if we're able to help that listing agent become more knowledgeable that they could potentially accept our FHA loan, especially if that condo's been sitting on the market for some reason, just keep that in mind when we're working with buyers. Like, if we go above and beyond, which that's not really going that above and beyond, we would look so amazing to our clients.
It's literally just a form that we need to fill out with some contact information, and our condo department, they know what to do and they're off and running. We just make some notes. Hey, we need a spot approval for this address, and they go do their thing. Let's put them to work. I mean, that's what they're there for. I have no
problem. And Monty just asked a good question. What's the approximate price for that?
Honestly, it's just a condo docs. That's it. Like, they just have to pay regular condo doc fees. What if they get into escrow and they wind up buying that property? Again, they don't have to pay for anything if they don't buy that property. And so if they buy a different property, they're not going to get charged for those condo docs. We'll make sure to include in the file, hey, by the way, this is not the same as that one, and they won't get charged.
But per the RPA, a lot of the condo docs get pushed onto the seller to pay for.
Two different sets of condo docs.
Okay.
Yeah. Lender condo docs are very different. So we require insurances. We require so their master insurance policy, that condo questionnaire needs to be filled out. We're gonna and a lot of times they, like I said, they go through like either condodocs.com or HomeWise or what have you, like Matt alluded to earlier, and it's automated and we can go on there and just pull it real quick. Sometimes they're like manual ones, right? That they have to actually fill it out. So what did I say? It was insurance questionnaire and financials we're gonna need from them. So it's one of those things where we can get these things pretty quickly. We're good to go. Like, it won't take long at all. We'll submit it over to the FHA and we should hear back in short order. It doesn't take long.
Good to know. Thanks for all of the answers.
Yeah, absolutely. No problem.
Mm.
And then Monty, as far as what's the rules and guidelines for buying down rates, I can have a class on rates and how they work, because that's a completely different topic. But yeah, I mean, every single rate has just to address your question, I don't want to like completely blow it off. But every single rate, man, there's a par rate. And then if you wind up going down in interest rate, you're paying money. Oh, sorry, going down in interest rate, you're paying money, right? And if you go up in interest rate, you wind up getting money back from the bank, because you're really just prepaying the interest up front for a lower interest rate during the terminal loan. And then there's calculations that you want to do, and I always help my clients with their calculations on how to break even, and how long it takes to break even, and whether or not it makes sense to do a permanent buy down versus a temporary buy down. And I can do another whole class on interest rates and teach you guys how that works. So that's not a problem. But moving along, because I don't want you guys to be here past an hour. So that's everything to do with condos right there. Don't forget, like, that 50% rule only has to do with investors. Like, if an investor is trying to buy an investment property in the condo complex, then they're going to look at owner occupancy. If it's an owner occupant going to buy there, that we don't care. A lot of big banks do. We don't. A lot of big banks do. They create their own overlays, right? I don't know if I've explained what an overlay is, but an overlay is basically a rule that a bank will set up to above and beyond what Fannie Mae and Freddie Mac have already given us as guidelines to kind of mitigate their own risk, right? And when you have super conservative banks like the Chases and the Wells of the world, they're going to have a lot of overlays on mortgages. We do not. We just go by their guidelines and just, hey, if that's what they say, we're going to give them the loan anyways. Like, that's fine. That's where the money's coming from. We're a direct lender for. Cool beans. Oh, one thing I did not mention, home style, you guys, don't pass up on properties that need a little TLC. We can do a renovation loan for them. If you find a property that's, $500,000-$600,000 and you think that there's $50,000 to $100,000 worth of work in there, as long as we're keeping under that 726,200, we can work in that renovation into the loan up front when you buy the house, get it all dialed in, and then they can move in and get their house fixed up like right away, which is awesome. It's an amazing opportunity. And I can provide all you guys with you know what I should do? I should get in touch with our renovation department and have them do a whole class for us, huh? How's that sound?
Yeah, Daniel would love to do it.
Daniel would love to do it. So I think I'm going to do that. I'm writing it down right now. Renovation loans, and we'll get that on the books over the summertime. How's that?
Yeah. And the VA just bumped theirs up. It's great.
Yeah, VA just went from $35,000 to $50,000 for, and it's so easy for us to do. All we need is a general contractor to go out there and give us a bid on what their plans are and how much it's going to cost. And then we take that bid, we hand it to the appraiser when we order the appraisal, and they go out and they appraise the property as if this is already done and not as is, right? You always see that as is button or check mark, right? This is as if it was. So they're going to find comps, right, that were updated. And so that they're going to compare apples to apples. So that way it comes in. And does that make sense, you guys? Yeah, hopefully. So there's different loans, there's different renovation loans for different products, conventional, investor ones. There's one for FHA, there's a couple for FHA. So don't let a house that needs a little TLC pass you up, because you might have a little hidden gem right there for your client and build a lot of equity really quickly. All right, so moving on. FICO, FHA. Why did I just read that out loud? So FHA, you guys, the reason why FHA came out, first of all, it does not stand for first time home buyer. Okay, let's just get that out there. It's not first time home buyer. FHA came out in 1938, okay, for the sole purpose of helping more people buy homes. And how do they do that? They lower the debt, they lower their FICO scores. So anyone that's a little bit more credit challenged, we will automatically shift to FHA, right? We'll compare and contrast and see which one's less expensive. We want people to pay less for their homes every month. We don't want them to pay more. So we're going to try to save them as much money. So we'll look at the FHA versus the conventional. But again, so lower FICO scores. Loan limits are the same here in San Diego. they're different up in Riverside. So and outside of San Diego, they may not be aligned with your Matt's shaking his head.
Yeah, no, yeah, be careful up in Riverside. Again, once you cross that county line, the FHA limit up in Riverside is 644,000. So it doesn't even go up to the conventional limit. So be very careful once you're going over that county line into Riverside, that you have spoken to your lender and they know what's going on with that.
Thank you. Absolutely, you guys. Be very mindful. And you guys, a lot of lenders don't know this information. It's kind of scary, to be honest with you. Especially here in San Diego when they start crossing the borders. One of the caveats for FHA loans got to be owner occupied. Same thing with a VA loan, you guys. They're owner occupied loans. You can't use an FHA for an investment property. I'm going to put an asterisk behind that, and I'm going to cover that in a second. They do have shorter waiting periods for credit events. Again, everything is really credit related and a little bit easier to qualify for the loan, right? So you don't have to wait 4 years for a short sale. You only have to wait 3. You don't have to wait 7 years for a foreclosure. Oh, it's only 3. You only have to wait 2 years, 1 year for a vacay. Whereas with, conforming loan limits is 4 years. So again, there is a little bit of, it's a little bit easier, right, to qualify for these loans. Mortgage insurance, again, now here's a big difference between FHA and conventional. Remember, I told you that mortgage insurance is going to go away with a conventional loan. With FHA, you're sitting on that MI for the life of the loan, right? And not only that, but you pay an upfront mortgage insurance premium. That's what that MIP stands for, if you ever see it. Upfront mortgage insurance premium. You pay 1.75% of the loan that you're borrowing gets tacked on. Even if you refinance, if you use an FHA loan to refinance, right? So you can do an FHA streamline, which is like a no doc loan, basically. Like you just have to apply and they lower your rate. But yeah, even if you refi, you still have that using an FHA loan. If you refinance into a conventional loan, that's when you eliminate that mortgage insurance, right? As long as you have that equity built in.
You got to have the equity still.
You got to have the equity. Yep. Does that make sense? Hopefully, yes. Okay, cool. So again, that mortgage insurance premium is financed. They tack that onto the loan amount. And it will change. So again, it was 0.85. It is now 0.55. With 3.5% down and 0.5 with so 0.5% if you put 5% or more down, right? So you gotta love me updating this the presentation as we go.
And you guys are going to see a lot more FHA offers right now because Eddie and I are doing the same thing, kind of weighing the pros and cons and monthly benefit between conventional and FHA because the mortgage insurance went down substantially on FHA loans. And so if you got somebody with a lower credit score, going conventional is going to be pretty expensive when it comes to mortgage insurance. So going FHA might be beneficial. So be careful when you're reviewing and you're seeing a lot of FHA loans. It doesn't mean, for instance, they have the worst credit or the worst anything. It's just because mortgage insurance might have just been cheaper in their instance. So
yeah, it's literally, I mean, we've seen it, what, like $300-400 difference on a monthly basis.
Huge.
Even with that 1.75 that we're tacking on, right, to the loan amount, we're still seeing a huge gap.
The biggest difference is going to be with your 3% down borrowers, switching them to 3.5% and going to FHA financing, because the 3% down with a lower credit score is really going to bump up that mortgage insurance on a monthly basis.
It's a lot, you guys. So we're doing all this analysis and we're making sure that we're providing that mortgage coach software that we have, and we're showing everybody, hey, these are your different loan options, and then you could choose which one you want, but hey, this one's the one that we're recommending. Questions about that? Yes, no, maybe so. No, cool. All right. So again, people get freaked out with FHA loans and VA loans because of the appraisals, but in all honesty, I mean, we just had that appraisal class a couple of weeks ago and we asked them straight up, like, hey, is it really that big of a difference? And it's really not that big of a difference. Yes, they look out for health and safety issues with government loans, but that's to protect the consumer, right? So if you have like, I don't know, a leaning fence, right? A railing that's like wobbly when you're walking up the stairs into the house. You have a brick that's sticking out, that's possibly a trip hazard in a walkway. You know, stuff like that, a broken window, right? Like exposed wiring. Like, why would you want to buy a house with that anyways? Like, wouldn't you want them to fix that up, right? So again, it's kind of one of those things where it's there. They are going to look for health and safety issues a little bit more than with the conventional loan, but I've seen them be nitpicky with conventional loans too. So it's like, you know, it really depends on the appraiser at the end of the day. So don't get freaked out if you're a listing agent and you get an FHA or a VA loan, because the VA loans, to be honest with you, are like the easiest loans in the world for us to do. they're the smoothest and the easiest by far.
Yeah, and their appraisals have a time frame. Like once they accept an order, their clock starts. So I know when it was super busy and trying to get an appraiser out was nuts, but since those days have kind of come and gone, getting a VA appraiser it's quite easy.
Yeah, it's been taking a week, maybe 10 days at the most.
And what do we got? Less than that.
Yeah. All right, so moving on, no flips allowed with FHA, you guys. This is a big one. Like, I don't want you guys to get stuck with a flip. Make sure that you're reviewing and you're diving into the properties that you're looking at. You're walking through a brand new home. You know your client's using FHA. That's why it's so important to have a good relationship with your lender, because you're in communication. You know what kind of loan they're doing. You go in, you look at that property, it's a flip. They just bought it 60 days ago and they're on the market. You can't put in an offer until the 91st day. Okay. From the last date of closing on that title report. So you want to pull the prelim. That's the first thing I would do, is I would pull the prelim on that report and take a look at it. And sorry, the property profile, not the prelim, but take a look at the property profile, see when it exchanged hands last, and just ask, you know, one of your devices, hey, Google, Alexa, whoever it is, what's 91 days after that? And then you'll know exactly when you're going to be able to put in that offer. But don't get caught like taking clients out to a flip property and then being like, wah, 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 I didn't know, so sorry, you guys can't get a conventional loan, you can't buy this place. Here's the carrot, you can't have it, you know? So be mindful on FHAs as far as that's concerned. With also with FHAs, the condos have to be on the FHA approved list. Remember, I mentioned this a little bit ago. Same with VA, they have websites that will require us to take a look to see if they're approved. And these websites, they kind of suck, you guys. Sometimes they use the HOA name, sometimes they use a track name, sometimes it's misspelled. Like sometimes there's so many different, sometimes they use a lot number, right? So just be mindful. Like if you have a question and you're looking for a condo complex, just reach out to us and we'll help you do the search, because we've done it so many times. We know all the little nuances to the searches that need to go in. But if you're going to go and want to try to look it up yourself, that's totally cool. The first thing I would do, again, pull the property profile from your title website, go down to the legal description, find that condo complex name, right? The legal name, and start searching keywords in that for that condo complex, right? Just one word at a time. And I wouldn't even like put it down to San Diego, because I've seen San Diego spelled wrong on these searches before, and it excluded a property that should have been included. So don't put anything, put like California, right? Just choose California and then start searching for keywords. And if the HOA doesn't come up and you want to keep looking for it, look at that legal description. It'll give you a lot number. Type in the lot number 562, right? Whatever. And look up the lot number. Sometimes it'll come up on there. If it's a track number, put in the track number, right? It might come up as a track number with no name associated to it. I found approvals like that before too. I've purposely misspelled a word that's commonly misspelled. And I found a place up in Escondido that was supposed to be approved, and that it was misspelled when it was put in. And guess what? It was right there the whole time. It was like Seaside. And I put in C instead of Seaside, and it popped up. So it's like, you got to kind of play with the searches. just so you know, if you're going to do it on your own, you just pay attention to those things. And then there was one other caveat with FHA that I wanted to mention to you guys. It's not on here that I should add. Oh yeah, the investment properties, right? Do you remember how I mentioned that you can put 3.5% down for the loan? Where is that loan limit? Minimum down payment, monthly MI. I don't even have a minimum down payment on here. Okay, minimum down payment 3.5%, right? So you can buy a multifamily with 3.5% utilizing an FHA loan. I did it in right out of college. I was 24 years old. My best friend and I bought a fourplex. Okay. And we wound up flipping the whole thing. Now here's the thing, right? You have to live in it. You got to live in one of the units. If you buy a 3 or 4 family, there's also a net self-sufficiency rule that FHA has. It's this stupid hidden guideline that's bitten me in the ass before, and I'll never forget it. Okay. But if you buy a 3 or 4 family and you're living in one, the other 2 or 3 units have to cover the entire pity payment. So they have to, or the rents in them have to cover principal, interest, taxes, and insurance. All right. But you can do it. You probably won't be able to do it around here. There probably won't be too many places that are going to have that rental coverage to make up the difference for it, but it is possible. And it is a strategy if someone's looking elsewhere for a property that aren't like, I mean, 4 unit, you're not going to find that 4 unit in less than $1 million around here. You know what I mean? So trying to get someone to cover it with the other units, probably not going to happen, but you can do it. All right. So I wouldn't necessarily, you may want to advertise it just to get some exposure, get some likes on your socials, but just keep in mind, you do have that net self-sufficiency rule that is in play. So it's a great way to open the door to have a conversation with someone, but it may not go anywhere. Again, 203Ks, renovation loans, right? They do exist and they're great loans. They're very easy to use. They don't take us any longer than a regular loan. I mean, 30 days, right? We just need to make sure that we have a contractor lined up. Oh yeah, and hey, by the way, that contractor can't be your relative. So don't go sending out Uncle Joe or your dad or you know, someone out there that you're related to. That doesn't work like that, right?
Your guy.
Your guy, right? Exactly. It's got to be your guy. With a different last name. So VA loans, I didn't say that. Shoot, I'm being recorded. I totally forgot. Just kidding. So VA loans, you guys, very, very, very similar to FHA loans. They're government loans. You may hear us clump govies together, and we're referring to FHA and VA loans. Again, 580 credit scores. You're talking the same loan limits. With VA loans, actually, I just kidding. Boom, there is no loan limit. They did away with loan limits a couple of years ago. So above 726,200 is just considered a jumbo VA. It's just a big VA. They still follow VA guidelines, not jumbo guidelines. They still follow VA guidelines, but there really is no loan limit. We will lend up to $2.5 million on a VA loan. You got to qualify for it. That's it. Income, debt, and assets, right? Cover those closing costs, but you can do 100% financing, believe it or not. You can have more than one VA loan, y'all. So if you bought a house in a less expensive area, you can wind up buying another home, and you're just limited to how much that you have left in your eligibility. And there's, again, with the government, everything is really convoluted, right? So they've got this crazy formula of calculations that we need to do to figure out how much you have left. But I have a client who is a real estate agent and here with us, and he bought a property for, I want to say $450,000, probably about 3 or 4 years ago. And he still has like $720,000 left on his eligibility. So, I mean, you can have multiple ones. You just need a reason why you're going to be buying a second home elsewhere. It's got to be a good reason. Again, all VA loans, any kind of government loan like FHA and VA has to be owner occupied. You can have another big misconception. You can have a non-veteran go on this loan with you, right? The only thing is that you got to put 12.5% down. Don't ask me
Wait,
what.
hold on a second. Can you say that again?
You can have a non-veteran go on a VA loan with you. Okay.
You just have to
No.
put 12.5% down.
Doesn't have to be a spouse. Okay. It can be your best friend, right? You guys can both go on it, but there is a minimum 12.5% portion. The reason why, and I'll just really quickly touch on it, is that the VA guarantees, okay, that loan, right? And the FHA, they insure their loans. So the VA guarantee is 25%. So because they have that 25% guarantee, the veteran, if they add someone that's not on the VA, right, doesn't have any VA benefits, then they have to cover their half of that guarantee, whereas the veteran automatically gets theirs. So you have 12.5% minimum down payment. Most of the time, it doesn't make sense, y'all, to have a go VA. And if you're putting that much money down, if you're putting that much money down, then the whole point of VA is 100% financing, right? Like for the most part. But that right there, that 25% in guarantee, you guys, that's the reason why you have VA and FHA rates that are less expensive than conventional rates, right? The government guarantees and insures these loans with that upfront mortgage insurance premium, right? So they collect this money from everybody that's taking out these loans. They go into a bank account, and if anyone ever defaults on the loans, there's money to cover that loan, right? So what does that do? That mitigates the risk for the bank to lend you that money. So if there's less risk to the bank, right, there's the lower interest rate, because the interest rate is strictly based off of how much risk am I taking lending this money to that person. So less risk, lower rates. So that's why you'll always see like a VA or an FHA loan have anywhere from 1/4 to 0.5% difference on any given day, right, to a conventional loan. The thing is that, like, again, we're going to do the math. We're going to do the calculations. If you've got the 12.5%, you might be better off just doing a conventional loan at that point. The nice thing about a VA loan is it does not have any mortgage insurance premium. It's a straight up principal, interest, tax, insurance. There is a slightly lower rate. The only thing is that you do have the upfront in mortgage insurance premium, but they call it a VA funding fee. Same thing, same concept that they have for FHA. It's called a little something different, right? So now if a veteran is disabled, they have that fee waived, right? They don't have to pay it at all. Or if they're disabled after they retire, they can petition to get that money back if they did buy a home while they were still active duty.
VA did lower the funding fee this year as well.
They did lower the funding fee, absolutely. So you have it was what 2.3? I think it's what 2.1.
It was 2.3. It is 2.15 on first time usage.
On first time usage, and then it was 3.6 on second use, and 3.3 now, right?
Correct. On subsequent use, it was 3.6, and now it's 3.3.
But I mean, think about that, right? You buying a second home using your VA a second time, not necessarily a second home, but a second time. 3.3% is being tacked onto that loan amount. I mean, that's a chunk of change. You've got a $500,000 condo. You're tacking on almost $20,000 extra. That's a lot of money, right? That's going to change your payment by a couple $100. So it's kind of one of those things. We're gonna do the math. That's what we do, and we're gonna figure out what makes more sense and what doesn't. So it must be owner occupied. Where am I? Co-borrower. Sorry, I don't like reading this stuff. I just like kind of talking about it. No mortgage insurance. I think I kind of covered all this stuff. And again, just like FHA, it's a government loan. They do have slightly lower requirements for credit events, right? So foreclosures is just 2 years. BK, if it's a 13, it's 1 year. So again, it's a little bit easier to get these done. And don't be scared of VA loans, especially here, man. We have last time I heard, maybe it was a year or two ago, it was 189,000 veterans like that live in San Diego County. That's a huge population of individuals, and they're constantly coming in and out, right? Between Pendleton, Miramar, 32nd Street, North Island. I mean, we've got a lot of places for veterans to be working around here. And they're some of the nicest human beings I have ever encountered and worked with, and always so respectful and always so quick to getting back to us. I mean, I absolutely love doing VA loans, and I hope that you guys take advantage of that and work with these folks. Oh, here we go. Look at that. I updated this. Here's the new funding fees, right? First time use 2.15, it drops on to 1.5 and 1.25. It's weird how I updated some of this and I just must have not finished. I saw a squirrel. If you do a VA cash out, there's still a funding fee. And then interest rate reduction loans, those are EARLs. You'll hear these. A bank can just lower the rate for somebody in every 7 months. We do require them to keep their loans for 7 months because you did have a lot of unscrupulous lenders out there that were churning their clients and just refinancing them all the time as rates came down. So now they make you make 6 payments before you can refinance, and it's only 0.5% that they tack onto that. Again, property has to be in decent shape. Just really no real health and safety issues. A couple of things to look out for, and I'm going to wrap this up as quickly as possible because we're going to hit the 1 hour mark here shortly. And I want to be respectful of your time. Termite inspection, you guys. I know that everybody says section 2 clearance is not necessarily required, but that's a call that's made by the underwriter. So depending what that section 2 clearance is calling out, they may require it. I recently had one because I was always under the impression as well, like section 1 always has to be cleared. Section 2, not necessarily, but if it's structural with the section 2 clearance, then they're going to make you address it. So I had an exterior hose leak that had calcified around the area where the hose was sticking out, where the faucet was sticking out of the house, and it was all calcified. And so the appraiser took a picture of it, and the appraisal underwriter called it out and said, hey, we got to make sure that this isn't causing structural damage and isn't rotting away at the posts that are holding up the house underneath, right? And that makes sense. That makes sense. It was section 2. And again, I got a lot of flack for it, but it is what it is. It was required. It had to get done. It got done. It got addressed. It was just a minor, stupid drip leak. They fixed the leak. Moving on. But section 1 always needs to be done. Condo units that are above the first floor don't necessarily need VA clearance unless there is something touching that ground floor. And again, it has to be acknowledged by the borrower that it is done. And you can use an older termite clearance report, as long as it's done within 90 days of closing. Okay. So it is a good idea. I mean, look, if you're getting into an escrow and you're taking a listing, right? Go out there and do the pre-inspections, invest some money into these things. Do get a termite report done right off the bat so you can provide it to somebody, right? I mean, what better way of like alleviating any kind of negotiations that you're going to have when you're being straightforward and honest with people up front, right? A lot of places around the country do inspection reports and provide it up front. Like, it's so weird. We hardly ever do I see that. But it's done very frequently around the rest of the country. So VA loan non-allowables, last thing I want to bring to your attention, be really mindful. Navy Fed is infamous for tacking on a 1% origination fee. So are brokers that are going to promise you a lower rate, but they've got a 1%. They've got a 1%. Did I say it right, Alicia? They've got a 1% origination fee. If you tack on that 1% origination fee, you can't charge all of these different rates, all of these different fees. Look at it. You can't charge for an appraisal, for photographs, for doc prep, for escrow, for notaries. So be careful. If that lender is charging an origination fee, you can wind up screwing your buyers because all of a sudden they're not going to be able to pay for any of this. And then when it comes down to closing, they're going to have to come in with a lot more money, and it's going to be a blind side to them, and they're not going to appreciate it at all. So be mindful of who you're working with out there. And then again, condos, whoops, what did I just do? Condos, you guys, just like FHA condo has their own VA portal to look up condos. This is the website to it. And just email us, give us the address and tell us to look it up, and we'll do it for you. So you don't have to deal with this, because there's a lot of nonsense involved, and I don't want you guys wasting your time. We could do it. Not a big deal. Cool, you guys. I think that's it. I think I got to the very bottom, very end here. Yep. Oh, here is the convoluted math formula to figure out if you qualify for a second VA loan. I mean, come on, really? Like, why do you gotta make it so complicated? Why can't you just tell me, hey, you have this much amount of money, I already use this much and this much is left? No, I got to take this number, multiply it by this. If it's less than that, I multiply it by 25%. If it's greater than that, then I multiply it by 75% to figure. Dude, you guys, it's just so stupid. So just be mindful. If someone already used their VA loan, they can use it again, but they got to calculate how much they have left. That's what I got for you guys today. Hopefully that was enlightening. We learned something new today about loans, and you will always have this on my YouTube channel to go back to and refer if you need any of this information. I'll take a snapshot of everybody that was here today and make sure that I get it out to you guys. I'll send you guys a copy of this so you have it. Cool. Awesome, y'all. Thank you so much for showing up.
Thanks for joining us.
Yeah. Sorry we had to go over a little bit. My pleasure, Rosemary. It's good to see the iPad on. I'll see you guys later. Have an awesome week. Call us if you need us. Later, y'all.